Have you ever found yourself, caught between two headlines that seem to say completely opposite things? One yelling about some impending crisis, the other saying, nah, everything's fine.
Oh, absolutely. It happens all the time.
Especially when it's about something personal like debt, right? Credit card debt in particular, it can be really confusing. Are Filipinos actually like neck deep in credit card debt? And what does that even mean?
Exactly. It's a huge question.
Well, that's the big economic question we're really diving into today. Our mission basically is to sift through a whole bunch of sources, news reports, economic analyses, even legal stuff and assistance programs.
Right, to get the full picture.
Yeah, to give you a comprehensive kind of nuanced look. We'll explore the different takes on debt levels, what's actually driving people to borrow, how it affects their financial outlook, and crucially, what tools and protections are out there for managing debt. So let's unpack this. Our deep dive kicks off right in the middle of a pretty major disagreement. On one side, you've got this assessment from Roshi Pete Ltd. They're a fintech firm in Singapore. And they paint a frankly alarming picture. They're saying credit card debt in the Philippines is at a critical risk level.
Critical risk? Wow.
Yeah. Roshi claims the average Filipino credit card debt is hovering around P92,800. That's more than 4 times the country's average monthly income.
4 times? That's a lot.
They talk about severe financial stress from this massive 425% debt-to-income ratio. They even say it's the worst in the region. Way worse than Indonesia. They put them at like 21% low risk, or even Vietnam at 127%, which is still high risk.
Yeah.
So it's pretty intense, doesn't it?
It really does. And what's fascinating here is how quickly you get a totally different story. Like, immediately challenging Roshi, their methods, their conclusions, is the Credit Information Corporation, the CIC.
Okay, the official body here.
Right. Their president and CEO, ACMEDI, Ben Joshua Baltazar, he comes out and says, hold on, the average credit card debt is actually way lower, more like P54,000.
Ah, okay. Big difference.
Huge difference. And here's the key thing he points out. Credit card loans. They only make up about 20 million active contracts, but there are roughly 390 million total active loan contracts overall.
So a small fraction, relatively speaking.
Exactly. Installment loans, you're talking 300 million. Salary loans, 50 million. So credit cards are, a much smaller piece of the pie than those headlines might suggest. And crucially, the CIC also says they haven't seen any major spike in defaults or missed payments on credit cards. No signs of widespread distress there.
Okay, so that definitely complicates the critical risk narrative.
It does.
And then just add another layer, we have ING Thinks Analysis. They take a broader economic view, looking at consumer debt and savings overall.
Right, the bigger picture.
They point out that outstanding consumer loans did hit PHP 1.69 trillion by late 2023. That's a pretty sharp jump from early 2022.
Okay, so debt is rising overall.
It is. And here's a really interesting shift. Credit card loans, now over PHP 680 billion, have recently overtaken car loans. They're now the biggest chunk of consumer credit.
Wow, okay, so credit card borrowing is growing significantly, even if it's not the dominant type of loan overall.
Precisely. But then ING Think also notes that the overall household debt-to-GDP ratio, it's still relatively low, just over 10% as of mid-2023. So the picture gets really complex, doesn't it? Debt's rising, especially credit cards, but how risky that is. Well, it depends who you ask and what metric you're looking at.
It really is a nuanced situation, isn't it?
Yeah.
Each report gives us a different lens. Roshi zooms in on that intensity of individual credit card debt versus income, highlighting potential personal stress.
Right.
The CIC, they give us that crucial context on the volume, how many credit card loans there are compared to everything else. And the fact that defaults aren't skyrocketing, that's reassuring on a systemic level. And then ING Think provides that macro view. Overall loan growth is up, yes, but the debt to GDP ratio still looks pretty manageable compared to many other countries.
So the takeaway is?
Well, the big takeaway here, I think, is that while individual credit card debt can absolutely cause severe financial stress for a lot of Filipinos, that Roshi report isn't necessarily wrong about individual cases. The broader data from CIC and ING Think suggests it's not yet tipping over into a full-blown systemic crisis for the whole country.
Okay.
It's that classic reminder, isn't it? Individual struggle doesn't always mean national collapse, and vice versa. We really need all these different data points to see the whole elephant, so to speak. Avoids jumping to conclusions.
Okay, so if it's not quite a systemic crisis yet, but clearly individuals are feeling the pinch, it's really important to unpack why people are borrowing. What's
Yeah.
driving this? Initially, when the economy reopened back in mid-2022, there was all that talk about revenge spending.
Right, making up for lost time, restaurants, travel.
Exactly, recreation, restaurants, hotels,
Mhm.
and that definitely gave household consumption a strong push for a while. But here's where it gets really interesting. There are some surprising insights from the Bangko Sentral Tongking Filipinos' Consumer Expectations Survey, the BSP's CES, which ING Think analyzed.
Okay, what did they find?
It shows a pretty big shift in why people are taking out loans.
Yeah.
While, maybe some revenge spending is still happening with cash people have.
They're using loans for something else.
Exactly. Consumers are now primarily using loan money for basic goods, essentials. We're talking a striking 54% of households now borrowing for this stuff. That's way up from about 35% before COVID.
Wow, borrowing for groceries, utilities, that sort of thing.
Seems like it. Business expansion and education are also up there, but the money borrowed specifically for leisure, it's barely changed. Still less than 1%.
That's fascinating. So the hypothesis is...
Well, the theory ING puts forward is that maybe consumers are kind of juggling things. They might be using their actual cash for the fun stuff, the revenge spending.
while using loans, credit cards, maybe other things to cover the day-to-day necessities.
That seems to be the idea. It's like trying to maintain a certain lifestyle or enjoyment level, but financing the basics with debt. A bit of a balancing act.
Exactly. A strategic, perhaps, but potentially risky balancing act. And adding to that, the CIC, we mentioned them earlier, they've also noticed that Filipinos are increasingly using buy now, pay later schemes.
Yeah.
BNPL.
Yes, BNPL. That's everywhere now.
It really is. And they're often just easier to get, right, processed online, right, when you're buying something. Super convenient.
Much less friction than applying for a card sometimes.
For sure. So that trend could be complementing or maybe even replacing some traditional credit card use for those very basic needs we were just talking about. It's quick, easy credit, but yeah, it still needs paying back.
And the knock-on effect of all this borrowing on savings, well, it's pretty concerning. We found data showing only about 29% of households were actually able to save by late 2023.
Only 29%. Oof.
Yeah, and that's lower than before COVID when it was closer to 38%. And it gets even starker when you look at low and middle-income households. They're the majority of survey respondents, remember. They're actually saving less now than they were during the pandemic lockdowns.
Wow. So their buffer is even thinner now.
Exactly. It really highlights how vulnerable people are if, an unexpected expense pops up. Less cushion.
That trend definitely raises an important question. What does all this mean for how Filipino consumers are actually feeling? Their overall sentiment and financial outlook. TransUnion did a consumer pulse study for Q2 2025, and it shows what I'd probably call guarded optimism.
Guarded optimism. How so?
Well, on one hand, nearly three-quarters, 73%, expect their income to go up in the next year.
Which sounds good, right?
That's positive. But at the same time, a big chunk, 44%, anticipate struggling to pay all their bills or loans. So, optimism about income, but real worry about covering costs.
A disconnect there. Did they report recent income changes?
They did. About 41% said their income had actually increased in the past 3 months. So there is some positive movement, but that worry about future payments is the crucial part. It feels like many are caught between rising costs and whatever pay increase they might get.
And what are their biggest worries specifically?
No surprise here, really. Inflation is overwhelmingly the top concern. Over 80% mentioned it.
Yeah, that tracks.
Followed by job security, that's at 59%, and then interest rates at 40%. It just shows how much these big external economic pressures are weighing on people's minds.
Are they changing their behavior because of these worries?
Oh, yeah. Consumers are definitely adapting. Nearly half said they've cut back on discretionary spending, the non-essentials. About a quarter trimmed digital services.
Okay, tightening the belt.
Right. But on the flip side, you also see proactive steps. 45% increased their emergency savings, maybe anticipating trouble, and 33% actually accelerated their debt repayments, trying to pay things down faster.
So some responsible adjustments happening too.
Definitely. It shows people are trying to manage things proactively, which is, a good sign.
Now, what's really fascinating is this kind of paradox around credit. More people, 58%, now see having access to credit as essential for hitting their financial goals.
Makes sense in today's world.
And confidence in actually getting credit has risen too, up to 44%. There's high intent to borrow, especially among younger folks, Gen Z and millennials. They're looking at personal loans, BNPL, new credit cards.
Okay, so demand is there, confidence is up. What's the paradox?
The paradox is that even with this high demand and confidence, A huge number. 57% of potential borrowers end up abandoning their credit applications.
Abandoning them? Why?
Mostly due to fear of being rejected
Hmm.
or simply because they think the cost of borrowing, the interest and fees, will be too high.
Okay. That's a huge disconnect. They see it as essential, but they're too intimidated or worried about the cost to actually follow through.
Exactly. And what's maybe even more puzzling is that the importance people place on monitoring their own credit, it's actually declining.
Really? That seems counterintuitive.
Yeah, it dropped from 72% down to 68%, which is the lowest it's been since Q2 2024, apparently. Especially among Gen X, only 60% see it as important.
Wow. That really suggests a critical need for better financial literacy, doesn't it? And maybe better tools to help people understand and manage their credit health.
Seems like it.
Because if you don't understand your credit or track it, how can you make informed decisions? How do you know if you'll qualify or if the interest rate you're offered is fair? Especially if you're already worried about rejection or high costs. It's a bit of a cycle.
Okay, so given all these complexities, the anxieties, the paradoxes,
Yeah.
it's absolutely crucial. People understand how to empower themselves when dealing with debt. Let's talk about debt collection for a minute.
Yeah.
In the Philippines, you've basically got two main approaches, right?
Generally, yeah. First, there's what's called amicable debt collection.
Amicable, meaning friendly.
Well, friendlier, hopefully. The idea is it prioritizes negotiation, trying to understand the situation, and resolving the debt without going to court. You might have agencies, like Debitura mentioned in the outline, helping with this.
And the big plus there is.
Avoiding legal fees, which can be substantial, and ideally, preserving the relationship between the debtor and creditor, if possible. It's about finding a solution everyone can sort of live with.
Okay, that makes sense. What's the alternative?
The alternative is judicial debt collection. This happens when the amicable approach doesn't work. The creditor then decides to file a lawsuit.
Right, going to court.
Exactly. They try to get a court order saying you owe the money, and if they get that order, it can eventually lead to court officers, bailiffs seizing assets to cover the debt. For smaller amounts, it might be small claims court. Bigger amounts go to the main trial courts. But yeah, it's definitely a more serious, formal, and often costly process. It's usually a last resort.
So knowing that, it's absolutely vital to understand your rights as a debtor, especially with credit card debt. What protections are there?
Well, the Bangko Sentral ng Pilipinas, the BSP, is very clear on this. They prohibit abusive tactics by collectors.
Like what kind of tactics?
Things like contacting your workplace about the debt or using threatening or offensive language. That's a definite no-no. You have the right to be treated fairly, to get clear information about what you owe, and to discuss reasonable repayment terms.
Okay, so what should you do if a collector calls?
Key step. Always validate the debt first. Ask them demand even proper documentation, like the original credit agreement, itemized statements showing how they reached the amount they claim. Don't just accept their word for it.
Good point. Validate first, then.
Then negotiate wisely. If you owe the debt, offer a realistic settlement or payment plan that you can actually afford, and this is crucial. Always get any agreement you reach in writing before you pay anything.
Get it in writing. Got it. And if they are using abusive tactics,
don't hesitate to seek legal advice. You can also file complaints directly with the BSP or the Department of Trade and Industry, the DTI. You absolutely have rights and protections. And beyond just dealing with collectors, there are actual programs designed to help manage debt. On the government side, you've got things like the PAGI Big Fund loan consolidation,
okay,
the SSS loan restructuring program,
right,
and the GSIS Financial Assistance Loan, or GFAL. That one's actually been extended, I think, until May 2025. So those are options for members of those funds.
and private options.
Yeah, many banks offer their own debt consolidation loans, which can simplify payments. And there are also nonprofit organizations like the Credit Management Association of the Philippines, CMAP. They can help you set up debt management plans and might negotiate with your creditors for better terms on your behalf.
So there are resources out there. People aren't totally alone.
Definitely not. The key is knowing these options exist and then doing the homework to see which one, if any, fits your specific situation.
Now, one program you mentioned, the Interbank Debt Relief Program, or IDRP. That sounds particularly interesting. It's run by the Credit Card Association of the Philippines.
That's right. And it's specifically designed for people who are really struggling with debt across multiple credit cards from different banks.
Okay, so not just one card, but several.
Exactly. Maybe you're juggling payments to 5 different banks, interest is piling up, you're falling behind. The IDRP aims to help consolidate that. It offers more favorable terms, usually a lower interest rate, and one lower manageable monthly payment. The goal is to prevent things from getting worse, stop the delinquency, and give you a path to get back on track.
Sounds like a lifeline for some people. What are the general eligibility criteria? Is it easy to get into?
Well, there are specific criteria. Generally, you need to have at least one credit card from a minimum of two participating banks. Your accounts usually need to be at least 6 months old, with outstanding balances over a certain threshold, say P10,000 per card, and a total combined debt of at least P100,000.
Okay, so it's for significant debt across multiple banks.
Right. And you typically need to provide proof of financial distress, show that you really are struggling to pay. You also have to fully disclose all your balances. There might be age limits too, or requirements for a co-maker if you're older, or your income isn't quite sufficient for the restructured plan.
It sounds like a serious program for a serious situation.
It is. It's a collaborative effort by many major banks, which is good to see. For anyone listening who thinks this might apply to them, we'll definitely put links to the detailed eligibility info in our show notes. It's worth investigating if you're in that kind of multi-card distress.
Okay, shifting gears slightly, let's quickly touch on microfinance loans and the really serious issue of predatory lending. Microfinance serves an important purpose, right? Small loans for low-income individuals.
Absolutely. They're typically small, short-term loans, and they are regulated. There's the Microfinance NGOs Act and BSP oversight. But defaults can happen here too.
And if you default on a microfinance loan.
The rules against abusive collection still apply. Philippine law is very clear. No intimidation, no harassment, no public shaming like posting your picture online, which some illegal lenders do, and definitely no unauthorized use of your personal data. That last one is a big violation of the Data Privacy Act of 2012.
Good to know those protections extend there too. Now, what about actual predatory lending? How do you spot that?
Predatory lending is basically when lenders exploit borrowers. They use really high interest rates, pile on hidden fees, use confusing or misleading terms, basically setting traps.
Is that illegal? Are there caps on interest rates?
Yes, it can be illegal, and yes, there are caps. BSP Circular Number 1133, for example, sets limits for small short-term loans, things like 6% nominal interest rate per month, which works out to about 0.2% per day. There are also caps on effective interest rates and processing fees. The point is, sky-high, triple-digit annual interest rates are generally not legal.
And transparency.
Also key. The Truth in Lending Act requires lenders to disclose all costs, upfront interest, fees, everything before you sign anything. No hidden charges allowed.
So if you think you've been targeted by a predatory lender, what can you do?
You have recourse. You can file complaints with the Securities and Exchange Commission, SEC, especially if it's an online lender, the BSP, or the National Privacy Commission if your data rights were violated. You can even take civil action in court to recover excessive payments you made. In some cases, if the terms are truly outrageous, a court might even cancel the loan contract entirely. There's case law on this, like Metal v. Court of Appeals, where courts struck down unconscionable interest rates.
So the law does offer protection against these exploitative practices.
It does. You just need to know your rights and where to go for help.
Okay. So bringing it all together, what are some general practical strategies for managing debt effectively? Just the basics.
Right. Well, number one is really understanding your own financial landscape. You need to know exactly what you owe, who you owe it to, and what the interest rates are. Get it all down on paper or a spreadsheet.
Know your enemy, so to speak.
Kind of, yeah. Then create a realistic budget and stick to it. Prioritize your essential spending.
Okay. What about tackling the debt itself?
Focus on paying off the high-interest debts first. That's often called the debt avalanche method. Make minimum payments on everything else, but throw any extra cash at the debt with the highest APR. It saves you the most money in the long run.
Debt avalanche.
Yeah.
What else?
Consider debt consolidation, like we talked about with the IDRP or bank loans, if you're juggling lots of high-interest payments. It can simplify things and lower your overall interest rate. And don't be afraid to talk to your creditors, negotiate. They might be willing to work out a payment plan, especially if you're proactive.
Okay. And crucially,
try your absolute best to avoid accumulating new debt while you're trying to pay off the old stuff. And finally, work on building an emergency fund, even a small one. Having that buffer makes you less likely to reach for a credit card when the unexpected happens.
But if it still feels overwhelming,
don't be afraid to seek professional help. Talk to a reputable financial advisor or a nonprofit credit counseling agency. Sometimes an outside perspective makes all the difference. You know, if we connect all of this back to the bigger picture we started with, understanding these rights, knowing about these resources like IDRP or government programs, and applying these basic management strategies, It really can empower you. It lets you take control of your financial journey.
Moves you from being reactive to proactive.
Exactly. It's about being informed, making conscious choices, rather than just, feeling overwhelmed by debt or scared by those conflicting headlines. The goal isn't just digging out of debt, it's building lasting financial resilience, no matter what the next economic report says.
So we've covered a lot of ground. We've explored these really varied perspectives on the state of debt in the Philippines, from those critical risk warnings to the more reassuring counter-narratives from bodies like the CIC.
Quite the range.
We've delved into the complex reasons behind borrowing. It's not just revenge spending anymore, is it? It's increasingly about covering basic, everyday necessities for many people.
A really important shift to recognize.
And we've highlighted the range of options, the rights, the resources available to people who are navigating debt, from understanding collection practices to specific programs like the IDRP. Ultimately, I think this deep dive really shows us that financial health, it's rarely just black or white. It's this whole spectrum, isn't it? A mix of individual choices, circumstances, and these broader economic forces pushing and pulling.
Absolutely.
So maybe the final thought to leave you with is this. How does understanding these nuances, the difference between individual financial stress, which is very real for some, and the perhaps less alarming overall economic picture, how does that awareness empower your own financial decisions?
That's a great question.
And how can you use that awareness not just to manage any debt you might have, but to actually build a truly resilient financial future for yourself,
Right.
regardless of what headlines might pop up next?